Hello and welcome back. So as we come to the end of the first quarter, I thought it would be nice to have a look at some of my most frequently asked questions when it comes to venture capital. So title, Venture Slowdown. What does it mean for the vintages, the funds that started investing from 2019 onwards until more recently? So, and what exactly does this mean for investors in venture capital? Let me just make sure everyone's on the same page and explain a little bit how venture capital works. I call it the flywheel. So venture capital funds raise money from LPs, from limited partners. Those are institutional investors, endowment funds, pension plans, and so on. They raise money from those LPs usually for 10 to 15 years. Those venture capital partners then make investments, usually over a 3 to 5 year period, into portfolio companies, those startups, and deploy over that time the capital that they've raised from the LPs. Now, every VC at one point needs to achieve exits. That means they have to sell their equity stake in those startups, either via an IPO, via a trade sale, or via a secondary sale to a later stage investor. So far, so good. Those exits generate the cash flow into the fund that will then ultimately distribute it back to the LPs, those institutional investors that originally invested in, call it fund number one. Now, because they're seeing exits coming out, they will then be incentivized to invest in the next fund of the venture capital firm. So far, so good. Now, this is literally a flywheel. The moment one of those, call it inputs, stops, the whole wheel literally gets stuck. And right now we are a little bit at that point where we have not seen enough exits in the last 2 to 3 years to kind of really allow venture capital funds to get excited, deploy more, raise the next fund, and so on. Now, what does the world look like first quarter 2025? This is a good time to take a look at the last year because usually it takes 6 to 8 weeks for venture capital funds to report their data. And so we have a pretty good idea what 2024 looked like right now. As you can see on this chart quite nicely, that 2021 was an exceptional year by many measures, whether it's by deal count, whether it is by deal value, total amount of dollars basically spent on startups. So as you can see, 22 and 23 was pretty much a pretty steep drop-off. I call it the VC hangover period after the party period of 2021. And we've seen 2024, the curve starting to turn a little bit. And I would argue the first quarter of this year, of 2025, was very positive. So there is a reasonable argument to be made that this basically trend, this upward trend will continue in 2025. Now, what needs to be added is that quite a bit of this uptick is driven by investment in startups focused on AI. The percentage of capital that was deployed into AI-focused startups is literally, depending on the part of the world that we're looking at, is way above 50%. Now, in addition, where we are right now, dry powder in venture capital remains high. Dry powder is the amount of money that has been raised, has been committed by the investors into venture capital funds and has not been deployed yet. Nevertheless, dry powder, whilst being high, is aging rapidly. The next slide shows a little bit what that means. As you can see on the right side, 2024, this is dry powder from funds that were raised in 2024. Now, 23 and 22 still has a substantial amount of money sitting there that has not been drawn down and invested yet, as has 2020 and 2021. Now, the moment dry powder gets to a 5-year vintage, if you like. So any of the funds around 2020, now that we are in 2025, are getting to the end of their investment period. What does it mean? That means they may have to go back to their LPs and ask them, what do we need to do with the dry powder? Do you want it back? Or would you like us to continue to find good startups to deploy dry powder in? We will see how this will basically play out. Next conversation point that is coming up, and I'm using the data here from Carta, but plenty of data providers have shown the same. We're looking at IRR, the internal rate of return by vintage year, meaning separated into groups of funds that did their first investment in those respective years. So what we're seeing is that median IRR for 2021 vintage funds remains below 0 after 3 years. It's one of those measures that a lot of LPs kind of look at. How is my portfolio performing? Which ones of my funds already have a decent IRR, can show a positive IRR? As you can see on the right-hand side, median IRR by vintage. Take, for example, 2017. In year 3, 2017 had an IRR of 4.6%. So that is basically kind of like let's call it an anchor for a lot of the LPs that are saying, well, in the past, the vintages have actually performed quite a lot better, a lot faster, have they crossed into positive IRR territory. We will see how this will play out. For the more recent vintages, I don't think those data points are quite meaningful yet, especially in venture capital, where it takes a bit longer to invest in startups and then ultimately really grow those startups to a point where you can see positive outcomes. What we've also seen in the last 10 years, that from 2014 onwards, the number of venture capital funds, of venture capital firms, literally exploded. It was a very consistent trend upwards. And again, you can see the top of that graph is in 2021. That means we saw a lot of first-time funds that joined the fray, that stepped in. We saw a lot of larger funds as well. The graph doesn't show that, but you can trust me on that. And what we've seen, obviously, in the last 2 to 3 years, certain funds just not raising follow-on funds. Certain firms not raising follow-on funds. Some of the firms actually deciding to leave the venture capital space. We will see how this will basically play out when we potentially have a look at this again in 6 months' time. Let's have a look what that means. What are the implications for venture capital funds and then also for investors as we're standing here at the end of the first quarter of 2025? So number one, expect to spend more time on the road for fundraising. 2023 and 2024 were the 2 record years in terms of time spent on the road. Way over 24 months for established funds to achieve first closing of their fund. LPs are waiting for deployment. They are waiting also to receive certain distributions back. We will see when this will happen. An interesting observation, and I'm just putting this in here, we saw that in smaller funds in the US, that they are actually, smaller VC funds in the US are achieving top decile performance. TVPI, total value to paid in capital. So, which is really interesting and kind of unusual, especially in the prior years, we've seen particularly large funds doing better than smaller funds. Now, waiting for DPI, that's all investors are asking, was what a guest speaker just recently in my class said. All the investors are asking for the DPI, distribution to paid in capital. In your past funds, how much have you given back to the LPs and how fast? When did you give money back? Usually in a venture capital fund, I think it's reasonable to expect distributions not much earlier than year 6 or year 7. Now, obviously for all the VCs sitting on the existing portfolio companies, the IPO window opening would certainly help. Now, that obviously allows us to take a look at the public markets, and we all have to say that this is becoming a more complicated conversation than we may have thought in January 2025. Now, what does it mean for investors? Investors very much may look at this as an opportunity. Secondary transactions right now in venture capital are particularly attractive. We have seen secondary funds being raised to take this as an opportunity. And it may very much be time for investors to say, hey, this may be an opportunity for us to get into investments, to get into funds that we couldn't get in the first time they raised their primary fund. Secondary is definitely a space to watch when it comes to VC. Low valuations may actually make this an attractive vintage, 2024, 2025, as you're starting to deploy capital now. Obviously, we need to keep an eye on how the investments in artificial intelligence will play out. And I think what the last 3 years have shown again is that vintage diversification matters in private capital. I would argue that LPs should see this time right now as an opportunity to deploy, to invest in primary funds, and use secondary funds to get access to earlier vintages at an appropriate valuation. But vintage diversification matters. I don't think this is a time right now to take the foot off the gas to deploy in venture capital. Thank you very much for listening. Please, if you like this video, subscribe below. I usually publish quite regularly new videos, and I will take a much closer look right now on 2025, where we are right now, what to expect, not just in venture capital, but also in buyouts, in secondary markets, and potentially also what this means right now for entrepreneurs and founders running their startups right now.